I feel like the tables have turned. It's usually you interviewing me all over the world. It's great to finally have you at our first Plume Denver Summit. For those of you guys who don't know, Paul is a good friend of ours. He is an expert in the blockchain space. I mean, you spent what, at least over a decade, right, in the blockchain space, chairman of the EEA, 10 years plus at EY, heading up the blockchain division, and spent some time at IBM as well, right, working on blockchain.
Yeah, I built IBM's first blockchain in 2013 on the alpha version of Ethereum, actually with a little bit of help from Vitalik.
There you go.
And moved to EY in 2015, and I am about a month away from my 10-year anniversary at EY running the blockchain business there.
Congrats.
Yeah, they haven't fired me yet.
No, I think you're a lifer there. But anyways, yeah, thanks for joining us today, Paul. We've spoken a lot across different countries, all over the globe, and I think we've had some pretty interesting conversations. I think one was at RWA Summit, the other one was the EEA conference, and I thought today it would be nice to kind of have you share more of your insights to, our audience here, especially more so on, kind of how EY approaches the blockchain space. So kind of getting into it, I'm curious, what has changed in blockchain adoption since, I guess, your inception at EY?
So we're 10 years in, right? We've now survived 2.5, possibly going on 3 market meltdowns. I would like to believe that we're still in the bull market, and I would say I'm still optimistic that what we've entered now is a period of mainstream adoption. So I think we always knew that the last few go-rounds were going to be ups and downs, and this time, though, I think it is different. We are entering mainstream adoption, and even if the price of crypto assets goes down, it will not affect widespread adoption. And the analogy I would draw on this is, if you go back to 1999, which very few of you can, maybe some of you can, the whole NASDAQ collapse, the tech marketplaces collapsed, all the prices for tech stocks collapsed. It didn't matter. In the end, adoption of the technology, the underlying technology, went right on going in the same direction. And so I think we are at that point now, largely also because the use cases like real-world assets and stablecoins are increasingly decoupled from the underlying crypto assets. And in particular, I get this question a lot as a chairman of the Enterprise Ethereum Alliance. People are like, oh, Paul, can't you do anything about the price of ETH? No, I cannot. There is a secret cabal of us who got together with Vitalik and we agreed upon the price of ETH. But we thought it was going to be higher. The reality actually is that ETH's low price is a function of its success. The complaint about ETH in the last 2 go-rounds was there isn't enough capacity in the network to support all the transactions. And so the price of ETH would rocket up with the gas prices and the transaction fees, and everyone's like, this is too expensive, I can't afford it. The difference this time is Ethereum is scaled through layer 2s. That is really fundamentally different. And consequently, the capacity in the overall ecosystem is just orders of magnitude, like literally hundreds of times of what it used to be. And in a business where ETH is fundamentally a computing platform, and the low prices are good for driving long-term demand. And I think low prices are good for luring people into transacting with stablecoins and real-world assets.
Yeah, I mean, I think that makes a lot of sense. I think you've definitely, been in the Ethereum ecosystem for a while, and you've kind of seen how everything has grown. And so, kind of a segue into my next question, I guess, what kind of barriers do you see for more like Fortune 500 companies, like IBM and all these other tech titans, to really break into the Web3 space?
So I think of the sort of big institutional enterprises as they fall into 2 categories: financial institutions, especially banks, and then sort of more, I'll call them commercial enterprises. So over on the financial institution side, regulatory clarity has been very important. And I'll give you, to some degree, it's been overstated, right? One of the things that sort of bothers me a lot is people are like, oh, we are not allowed to be in this business. That's simply not true. Look at PayPal, Fidelity, Coinbase. You can sell crypto and crypto assets to your customers. And people who say you can't are kidding themselves. They're using the lack of regulatory clarity as like a shield to tell others like, oh, we can't be in that business. It's risky and scary. There is a legitimate concern over on the banking side around the application of KYC and AML rules. Stablecoins, real-world assets, properly tokenized assets are bearer assets, and at least where it applies to banks and their regulatory environment, is basically not allowed. That's why you need this like stablecoin legislation and regulatory changes so that the banks can do this without violating the law. If you flip over to the Fortune 500, like the commercial side of the house, with the exception of strategy, right, MicroStrategy, now strategy, right, most corporations are not investment portfolios. They are not accumulating ETH or Bitcoin in their treasury, right? Their revenues are in dollars, their expenses are in dollars, their shareholder dividends are in dollars. So what they really want are stable coins. They want stable coins, they want efficient access to all of that. The big issue for these kinds of companies is all around privacy. It's an issue for institutional traders as well, but it's also a big issue, even bigger issue for large companies. Basically, all business transactions are, I have money, you have stuff, and we're going to exchange my money for your stuff under the terms of some kind of an agreement. I don't want my competition to know how much I'm paying, what of your stuff you're buying, and the key terms of our business agreement. And given that all of that's public on a public chain, it's kind of useless for large companies. So the big priority for EY over the last 10 years has basically to build privacy on chain. And and I know this is a horribly long answer.
No, it's a great answer.
There's a really good precedence for this. In the early days of the web, and again, all of you are just way too young to remember life before like you could buy stuff online with a credit card. You couldn't, or it was a stupid idea because there was no encryption on the web. Now, once we had encryption on the web, then we could suddenly put our credit card numbers in without worrying that they would always be stolen every single time. That's what we need in blockchain. We need privacy infrastructure that runs on public chains.
That makes a lot of sense. And you guys are also building out Starlight, right? The privacy product?
So we have built, at EY, we built two privacy technologies. Both of them are public domain, open source. One is called Nightfall. Nightfall is a zero knowledge. The Nightfall version 3 was a ZK rollup. Nightfall version 4 is a ZK rollup with instant finality. 3 was a ZK optimistic, 4 is a ZK. One zero knowledge for privacy, 1 zero knowledge for instant finality as a rollup. Nightfall lets you transact with ERC20s, 721s, 1155s, 3525s with other parties under privacy. And it runs, you can run it basically as an Ethereum L2, or I would very much hope to see on top of Plume as an L3.
That'd be great, yeah.
So you can have institutional privacy, you can have the protected privacy of your trading positions. It's public domain open source, by the way, github.com/EY blockchain. Secondly, we have something called Starlight. So if we come back to this thing, what's in the business agreement? I've got money, you've got stuff, and they're transfer. In financial markets, it's mostly a swap. So that's relatively straightforward. But what happens if you want to have a complex business agreement with logic in it? Then you need to turn your business logic, your smart contract, into a zero-knowledge circuit. And what Starlight does is it basically lets you take a Solidity smart contract and turn it into a zero-knowledge circuit. And so we're working. We have a couple of case examples like renewable electricity buying, enterprise procurement, where the key business terms of your agreement can be turned into a zero-knowledge circuit that runs as a privacy-enabled black box on-chain.
Yeah, that makes a lot of sense. I actually think I reached out to one of your teammates about Starlight, so we definitely got to pick up the conversation there. So as a follow-up question, Paul, I've got to ask you, public versus private blockchains. How do you view this? I know, like, in your world, you kind of just touched upon it. I'm starting to see some sort of crossover, right? I was speaking in New York a few months ago, and some of the more TradFi type RWA projects were looking to more permissionless blockchains. But I'm curious, in your world, how are people kind of viewing these types of blockchains, and what's the future there?
So thank you for giving me this opportunity to shill shamelessly. I think one of the things I am exceptionally proud of, we have never recommended a private or permissioned blockchain. Frankly,
there you go.
they are pointless, right? You just have to think, it's in the name, right? What is the point of a centrally managed decentralized ledger? It's a bad idea from the get-go. And it's been a real struggle over the years. Like, I used to joke that I was like the least popular partner inside of EY because people would blame me for going to their clients. They're like, I had sold them Hyperledger, damn it. You ruined that sale. Now they're not going to buy anything. And it was one of the most shocking things to me is how many people did not understand that private blockchains have no privacy. As one of my friends put it very nicely, it's a nude beach. Now, a private blockchain is like a private nude beach, but it's still a nude beach. You're going to see everything everyone else is doing, and that's not going to work for almost anybody. And that's why a lot of these like consortia collapsed, because at the end of the day, they didn't get any particular benefits from being private. And if you're going to build a privacy-enabled kind of solution and you want it to be centralized, you could just do that so much easier with a web server. So our view to be maximally slightly controversial is actually relatively straightforward. Number one, only public blockchains have a point. And number two, frankly speaking, only Ethereum is worth building on. And that's not because Ethereum is good or special or magical, although I think it kind of is all of those things. It's because fundamentally, blockchain is more a technology than a financial market, and technologies like standards, right? Windows is 90% of the PC business. Android is 90% of the phone business. Technology developers like standards. It's not going to be any different for blockchains, I think.
Yeah, that makes a lot of sense. I mean, we've been speaking with a bunch of different asset issuers and more traditional folks, like I mentioned earlier, and they're all looking to shift more to a permissionless blockchain, similar to Plume and how we're approaching the RWA ecosystem and kind of creating these different use cases that can take a more static asset dynamic and give it more utility. So I guess this is a good segue into my next question. What are you guys doing in the tokenization space recently? I know you guys are pushing pretty aggressively, or maybe not. I'm curious to hear what's the latest.
So I would separate what EY is doing versus how we view the space. So in terms of the space as a whole, I'm extremely bullish. Before I answer the more question about the space, I'll just say in terms of what we are doing, the answer is we are somewhat limited in what we can do. We are a regulated public accounting firm, which means that we can't actually build tokenization software for use by financial institutions. So we can do all kinds of other things. We can build it for you as a work for hire, but we cannot license it to you as software, because if you minted tokens using our software and they ended up in the hands of one of our audit clients, we would essentially be considered to be evaluating our own work, which the regulators say is not allowed. So there's limitations on what we can do. We are still building some tooling. So we have a smart contract. Again, we can't call it audit. We have a smart contract testing and review service, which I think is probably, frankly speaking, the best in the entire world right now. We've had a team in Israel working on it for 5 years. We don't advertise it much, and you're not allowed to put like some kind of EY stamp of approval, but we are winning big deals with major institutions for smart contract security. We have our audit infrastructure, which verifies transactions on chain. All of our audit clients that have crypto assets use it. And then some non-audit clients also use it. Like Fidelity checks every one of their transactions every day in our infrastructure so that they have an external data point to validate against their internal data. So we are investing in this space, despite the limitations from a regulatory standpoint. From an overall standpoint, I'm just kind of hugely optimistic. The vast majority of the assets that are going to be created in this world, on the world of crypto, are going to be real world assets. And the question is really going to be what kind of assets, and then how long is it going to take for this to become mainstream? I just wrote an article, which I think is going to get published in CoinDesk today or tomorrow, about the kind of long-term roadmap. Today, the vast majority of the world's like institutional money sits in pension funds and sovereign wealth funds. And regulators have said for a long time, if you're running a pension fund, you must be a fiduciary. A fiduciary means you are legally required to invest in the best interest of your client. The way that you prove that you have invested in the best interest of your client is by buying index funds. They are rigorously tested, academically sound. That's why the vast majority of investment money is in index funds. Eventually, with real-world assets, we can have the same level of data quality and academic rigor around traditional stock index funds, except for that we'll be able to have like an index fund of Thai real estate, right? Japanese semiconductor manufacturers, all these things that you can't do today, we will be able to do in the future. What I think everybody has to keep in mind is the time frame that's required. It will take, I think, probably a decade for us to figure out how do we tokenize things in a way that works. We're seeing this already. It's a great example, like property development. Am I buying a square meter of Thai real estate? Am I buying a share of a SPV? What am I buying? And getting to something that looks like a standard, scalable, repeatable set of standards for growing this up is going to be time consuming. A good data point, a good example to think about progress-wise, and I don't want to scare you, but in the 1950s, 98% of all retirement savings were U.S. government bonds. It wasn't even stocks, it was just U.S. government bonds, right? In the 60s and 70s, people invented, they came up with a market-facing theory about sort of perfect markets. Burton Malkiel wrote an amazing book, which is still super relevant today. It's called A Random Walk Down Wall Street. Index funds came about. Today, 40 years, it took about 40 years to get from 98% bonds to 70% stocks, most of them index funds. So you should think about like, of the $800 trillion in global assets, it's going to take 40 or 50 years before 20, 30, 40% of that is in tokenized assets. But still, 40 years for 40 trillion, it's manageable. I think U.S. can survive on that.
1 trillion a year.
Yeah, exactly.
Yeah, we'll take that. We'll take that.
Yeah, that seems reasonable.
Yeah, I mean, I think that makes a lot of sense. It's kind of aligned with kind of what we're seeing at Plume. Like, we have this core product called Nest, where we can create more like index type products, more isolated vaults to help stream these different types of assets to our like end users. And kind of like what you were saying, I think that's kind of a good segue to initially get demand on chain to start building, you know, the story and the narrative and the education around RWA. So my next question actually is, you know, given the different administration now in the U.S., how do you view the regulatory landscape moving forward?
So I think we are undergoing what I would describe as revolution by acceleration. Like, whether you like it or not, we went from nothing is allowed to go ahead and do whatever you want. And now, if your timeline extends beyond the next 4 years, you can't just go and do whatever you want. I think, in general, lots of stuff is going to be possible that is quite reasonable. However, if you're a relatively mature institution like EY, you have to wait for somebody to write the new rules down so that later on nobody can say you did this illegally, right? You waited until the rules were written down. But the advice that I'm giving to my clients is, if you want to be in this business, you need to get in this business now. And the reason you need to get in this business now is because historically, go back and look at all these like technology markets. And again, a lot of this hinges on whether you believe that crypto and blockchain are going to behave more like a technology or more like a traditional financial market. But if you think it's going to behave like a technology, the thing you need to remember is Microsoft has been the king of the operating system heap for 30 years, right? Apple has basically been the king of like mobile for a decade, right? Apple and Google. SAP has been the king of ERP since they invented that business like 50 years ago. The early winners in industry after industry, in case after case, the people who are successful early on are almost impossible to dislodge. So unless you want to be playing catch up for the next 50 years, and by the way, every bank on earth is trying to enter the stablecoin business right now. If you want to be in the stablecoin business, and I personally think your odds of like unseating Tether and USDC are low, but there are other spaces to be pursued that are not mature yet. But if you are not in the business now, there is a good chance you will be like IBM in cloud, running to catch up for the next 50 years.
Yeah, that makes sense. So I guess, you know, we're running up on time. My final question is, I know you've, you know, chairman of the EEA, you've been working at EY for over a decade. what have you seen as like the killer blockchain use case amongst all these different enterprises?
So I really thought that basically sort of business operations and procurement would be this like killer use case. And the problem has been that getting the cost of privacy transactions down to a level that's manageable has kind of prevented us from getting there. But procurement is a really good example. Companies are great at negotiating deals. They are terrible at remembering, like 6 months later, like, wait, was I supposed to get a discount? Where's my rebate? They're really bad at that. And so if you could automate that all into a smart contract, it would be insanely valuable. And we are now starting to get there. So I'm excited about that. I used to think that people would do like non-financial stuff first, and when they got comfortable with it, it's sort of like the easy stuff, they would go into financial stuff. I think what I'm now seeing, if I did to make a new prediction, it would be the killer use case in the world of blockchain is going to be stable coins. And I'll give you some very specific numbers. Last year, EY received the first B2B stablecoin payment from PayPal using the PYUSD. We did it in cooperation with SAP, which is like the big ERP vendor, and Coinbase. So PayPal paid an EY invoice. They paid it directly from their digital wallet, which was part of their SAP instance, and it went to EY's custodial account at Coinbase, and then in our ERP system showed up as a cash payment against our invoice. That level of automation is incredibly important because what it now means is that companies can switch to stablecoin payments for business transaction at scale with full automation, and we calculated it out. And we can't do this for regulatory reasons yet, but if we could replace all of our traditional B2B banking payments with stablecoin rails, EY, which is a $50 billion a year corporation, could save $100 million a year. There are lots of other companies that we are talking to right now who are like, I want to do that. I want that kind of savings. Right, so I think we will see very large-scale B2B stablecoin payment adoption in all the jurisdictions and where it is legal and can be done cross-border.
Yeah, we're actually starting to see that too from like a more micro level, I'd say, like on at least within Plume and other blockchains. I mean, today we had a whole panel on stablecoin adoption. It's definitely, it's the first true real-world asset that has product market fit, not even just in RWA, just in crypto in general. But yeah, I think we're up on time. You have any final words you'd love to share with us?
If you are a company in the Ethereum space, please join the Enterprise Ethereum Alliance. We are here to represent your views and interests. We have a very close relationship with the Ethereum Foundation. And notwithstanding any of the nonsense that you may hear on crypto Twitter, the Ethereum Foundation is active, they are engaged, they listen to what we have to say and to what others do as well, provided you don't phrase it as a misogynist rant on Twitter.
That is true. I can attest to that. I was, we were in Bangkok, right, last time.
Right. Yeah. Vitalik came. Yeah. Right. We are, the Ethereum Foundation does listen to the requirements of business users. They really do.
When's the next EA conference?
We are working, I think we have a new plan now, which is we want to take the layer 2s and the big Ethereum businesses, instead of doing our own conferences, our plan is to actually take them to the big business events that they're not going to. Like Sapphire is SAP's user conference. SAP is the ERP of the world's biggest companies. We need to have an Ethereum booth there where we talk to business users about something they've never seen before. So that's our next big goal, is taking Ethereum to business users.
Awesome. Well, I think we're out of time here, so let's give it up for Paul.
Thank you.
Thanks for speaking today. Yeah, great to see you.